In this video, you will learn my entire earnings trading strategy using my live FedEx earning trade as a guide. And make sure you watch this video all the way through, as it's recorded in real time and it explains exactly how I select the right earning stocks to trade for this strategy. I am in the process of creating an in-depth tutorial of this particular earning strategy, so make sure you subscribe and hit that bell notification so you don't miss out when that video gets released. Now, the first step is to outline the trading strategy. I'll be using an options trading strategy called the short strangle. The short strangle is where you sell an out-the-money put and an out-the-money call at the same time. This creates a range where we profit if the stock stays within that range. The short strangle is a premium selling strategy where the premium collected is our maximum profit. The reason we target companies which are due to release earnings is that generally the stock's implied volatility is at its highest just before earnings due to the unknown. High implied volatility is one of the main components which determines the option price. So as option sellers, we want to sell premium in high implied volatility market conditions. And after earnings, when the unknown becomes known, implied volatility contracts, also known as IV crush, where we can buy back the options we sold for less and lock in a profit. So the question becomes where can we find companies which are due to release earnings and their stock has a high implied volatility? I like to use earningwhispers.com, which has an earnings calendar for every single stock. My tip here is to select stocks with the high liquidity, as it's easier to get filled. And our goal is to exit the trade as quickly as possible after the earnings release. The next step is to check the stock's current implied volatility against its historic volatility over the past year. Using my FedEx trade, their earnings are after the market closes, so we want to check the volatility on the day of earnings. Here we can see FedEx has an IV rank of 59.4% and an IV percentage of 75%. I will save the explanation of what these means in the in-depth tutorial video, but I like to see an IV rank above 50% and an IV percentage above 70% to ensure we have higher than normal implied volatility conditions. Now that the stock has met these criteria, it's time to place the trade. If the company releases earnings before the market opens, we place the trade the day before, usually an hour before the market closes. In FedEx's case, they release earnings after market close, so we will place the trade an hour before the market closes on the day of earnings. We want to select the closest option expiration cycle to the earnings date. To determine the strike prices of our put and our call option, I prefer to sell anywhere between the 10 to 15 delta. Delta can be used as a probability of the option being in the money at the date of expiration. In other words, we have a 10 to 15% probability of our trade not working out as we planned, and where we would need to adjust the position to make sure we don't end up with a massive loss. So we're here now looking at the options chain for FedEx. As always, as I mentioned, we are looking at the closest expiration to earnings. So that is this Friday, 3 days out. If we look at the delta on the put side, I'm looking around the 10 to 15 delta. But in this example, again, I'm going to skew this more to the downside because I don't believe FedEx is going to continue to rise, just mainly down to the market conditions. So I'll probably do the 17 delta, look to collect about $141. And I was looking at this earlier in the day of the 182.50, and this has a delta currently of 11. I think that's a pretty safety net for downside protection there, as well as my kind of break evens at whatever I get filled at. So if we look at the current pricing of this, we've got 68 on the put side, and we have 142 plus 142. So we're looking at $210 here to get filled. So I'll have a look at that to see what we got filled at, and I'll show you guys all the details. Here is a screenshot of my order. So I managed to get filled at 8:07 p.m. So in the UK, the market closes at 9 p.m. So 53 minutes or around an hour before the market close, I like to place my earnings trades. So we've got the put side at 150. I got filled at 104. And the 182.50 call, I got filled at 97. So taking both of those options together, my total premium, my max profit is $2.01 or $201. And I've also placed a good to close order to buy back this whole strangle for $100. So I always look to gain 50% max profit from these trades. And hopefully when the volatility contracts tomorrow, and again, we went through the figures before, I'll take a screenshot actually of the volatility post earnings so you can kind of see what the difference looks like, and hopefully we can get filled very quickly. In terms of the capital required for this trade, it was just under $2,000, and if I'm looking to make $100 out of the $2,000, so that's roughly around a 5% return. So depending where I get filled, I'll show you the actual return on investment. What we'll do now, I'll visually show you what this looks like in TradingView so you can see where my put strike is, where my call strike is, where my break evens are, and show you the range that we have to work with for FedEx's earnings. So this is how it visually looks on the chart. You can see here we've got the call side at 182.50 and the put side at 150. So that creates our range, and we need price to stay within this range within the next 3 days. We also have our break evens. We got filled plus commissions at $201. As you can see there, that takes the call side break even to 184.45 and the put side to 148.05. So we have a bit of cushion if there was a massive move down to give ourselves some cushion over the next 3 days or so. But as I've mentioned before, I'm looking to take 50% of the maximum profit. So the maximum premium I collected is $201. I have a good till cancel order to buy back this whole strangle for $50, and I've got a high better win rate of managing my winners, taking my risk off the table, and especially with this only being a 3-day option, I'm really looking to get this filled tomorrow morning at some point. If this goes in the wrong direction, well, not even the wrong direction, it doesn't matter which direction it goes in. If it blows through it, either my call or my put strike, I will walk you guys through how I'll manage this trade. So I'll see you guys tomorrow morning and let you know how I got on with this trade. So it's end of market day and FedEx was up 3.43%. They released pretty good earnings, and as you can see on the day, it gapped up significantly all the way up to highs of 174.65 before ending the day at 169.99. So overall, you can see that there was a push up on earnings, but it was nowhere near my call strike or my put strike. And because of that, we were able to exit this trade 13 seconds into the market open. So the good to cancel order of buying back the strangle for $100 was triggered. I actually got filled at a better price than what my good to cancel order was at, and this is a perfect example of this earnings trade working out completely well. It doesn't always work as quickly as this, but this is probably the textbook example. So if we remind ourselves pre-earnings that we had the IVR above 50 and the IV percentile above 70, and here's the screenshot again where we sold the 150 put, the 182.50 call, obtained a total premium of $2.01 or $201, and I had a good to close buy order to buy back this strangle for $100, netting me $101 post commissions, but you can see the commissions are negligible in this example, and the total requirement was just under $2,000 to place this trade. Now just remember 59.4 and 75. So you can see this screenshot was taken shortly after the market opened, probably about half an hour into the market open, and where this was in the 50s, it dropped to 26 0.8, and you can see the 5-day change. You can just imagine it was a positive +2, and taking the last 5 days into account, dropped by nearly -10%. And the IV percentile dropped way below, down to 23%. And that's an example of after earnings of volatility contracting together, and therefore making those options that we sold for $201 to contract very quickly, even though there was a massive jump up by 4 or 5% on the market open. So if we have a look at what happened here, is you can see it, the market opens at 2:30 UK time. 13 seconds it took for our good to close order for $100 to activate. And if you actually add the two numbers together, instead of getting filled at $100, I got filled at 89 cents or $89. So actually I got a better fill than I was hoping for. And therefore that leaves me down with the total profit for this trade of $112. So again, just a little over 50%. That's what I target with these trades, is trying to make 50% of the total premium received. So in this example, I've got slightly better than 50%. And if we have a look at the return on capital of the $1,941 I had to put up, I received $112 net after it's all said and done. Yes, you got to minus a few dollars for commissions here, but that's a 5.7% return in 13 seconds. There's no interest rate that at the moment where you can put your savings into over a whole year, let alone in 13 seconds. Hopefully this makes sense to you. I tried to go into as much detail as I can. Like I said, I'm working on a official tutorial video. Depending on when you're watching this video, the tutorial, the actual earnings tutorial in depth should be on screen. If not, then what is on here now is my rolling options. I probably have both videos on, because there are examples where this does not go to plan. And when this does not go to plan, whether it blows through your call strike or your put strike, then you have to make what's called adjustments to the trade, trying to, close down the gap of a potential loss or potentially scratch the trade if you can. So check out rolling. Rolling is a very important part of this process. A lot more will come into that in-depth tutorial video.